Hi everyone, this is Dr. Nitin Chhoda, and in this training video, I'm going to talk to you about the future of negative interest rates and what this means for you. I'm going to go over three things in this training video. The first is, how does our economic machine work in a normal world? Number two, how our economic machine works in this new world that we live in this post-pandemic world, if you will. And number three, what does this mean for you? What's the bottom line impact for you? Before we get into all of that, let's go over some basics right now. What does a negative interest rate mean? In order to understand that, let's try and understand what a low interest rate means to begin with. So when you put your money in a bank, you get back a very small amount of interest from the bank for the bank to store your money and have access to your money. So you actually earn interest for putting money in a bank in a normal world. Now in a negative interest rate world, you would actually have to pay the money for the privilege, if you will, of storing your money with them. So let's say you put $100 into a bank account. After a year, you would have a little less than $100. That's actually what negative interest rates mean. Now if you're thinking that's ridiculous, well, there are actually 5 countries in the world that have negative interest rates at the moment. These countries are Switzerland, Denmark, Japan, Sweden, and Spain. Now, I'll talk about what these countries did and why they did it in just a couple of minutes, but what's the impact for us here in the United States? According to a recent article in the Wall Street Journal, negative US interest rates, don't bet on it. That was the subject line of the article. Now, one market did show that negative interest rates are likely to occur in 2021. In fact, negative interest rate futures have now started to pop up. However, many individuals are calling this a distortion caused by technical factors. So the Federal Reserve officials basically said the central bank is not considering cutting interest rates below zero, but however, one market still isn't ruling it out. Federal funds futures, which traders used to bet on future central bank policy, on Thursday showed that there was a probability of negative US interest rates by April 2021, even though Federal Reserve Chairman Jerome Powell said on Wednesday that the central bank was not contemplating such a policy. So this is out there, it hasn't happened yet, and the Federal Reserve Chairman said it's not likely to happen. But basically, Wall Street analysts are speculating, and they generally are not predicting negative interest rates, but many said that the Federal Reserve has other options in case the economy gets slower and slower, because this is essentially a last resort for economies having negative interest rates if the economy significantly slows down, because then they're encouraging individuals to spend money as opposed to save money or put it in a bank account. That's essentially the underlying economic reason behind negative interest rates and behind the decisions by the 5 countries I mentioned earlier that do indeed have negative interest rates. Now remember, negative interest rates have never happened, never in the history of the US economy, and I think the probability of negative interest rates happening are very low. I would say they're almost zero. So with that being said, let's go over some of the basics and how our economy works in a normal world. The way our economy works is you have a buyer and you have a seller. Now the buyer buys things either by using cash or by using credit. Now, a lot of individuals use credit. In fact, credit is not a bad thing when used responsibly. So again, a buyer can use cash or credit to purchase things from a seller. A seller usually provides goods, usually provides services, or financial assets like stocks, bonds, perhaps even real estate. So again, on the one hand, you have a buyer, on the other hand, you have a seller. And then when they engage in a transaction, it's called a transaction. The way an economy works is the greater the number of transactions and the greater the amount of money exchanged, the more the economy grows, the bigger the economy. And so essentially it's that credit, which by the way creates debt when you take advantage of credit. That credit drives the US economy. Again, when credit is used responsibly, that's a good thing. So in a normal world, again, you have a buyer, you have a seller. The buyer uses cash and credit, and the seller usually provides goods, usually provides services, or some sort of financial assets. And using a combination of debt from the buyer's side, the buyer is now able to buy things that they would not normally be able to afford. Maybe a nice car, that's where you have a car loan. A nice house, or a house that you wouldn't be able to afford in cash, that's where you have a mortgage. Nice things that you buy from stores, going out to nice restaurants, things you would not normally do unless you put it on a credit card and then had took advantage of debt and credit. So those things, when used responsibly, can actually build long-term asset value and can actually grow economies and grow wealth, which essentially is how the US economy has been functioning for many, many years. So again, the US economy grows based on A, the number of transactions, and B, the size of those transactions. Now, here's the interesting thing. We as consumers do transactions with businesses. Businesses do transactions with banks, and banks do transactions with the federal government. So let's sort of go over some of our basic systems. We have the federal government, which basically consists of two parts. It consists of the central government, which essentially collects taxes, which decides how to spend the money, and so on and so forth. The central government creates foreign policy. And then on the other hand, we have what's called as a central bank, also known as the Federal Reserve, also known as the Fed. The Fed primarily has two functions. They control the flow of cash and they control the flow of credit in the economy. By the way, this goes back to the buyer. Remember, I said the buyer needs cash and credit. The Federal Reserve, also known as the Fed, also known as the central bank, controls the amount of cash in the economy and can print money if needed. And they also control interest rates. And these interest rates in turn determine how much we pay for a mortgage, how much we pay for a car loan, what are the interest rates we generally tend to pay on our credit card statements. So when the Fed makes these adjustments, and by the way, the Federal Reserve meets 8 times a year to set what's called as a federal funds rate. The federal funds rate is the rate that one bank pays another bank in order to borrow money. The lower this rate, the easier it is to borrow money because the interest rates are low. Now keep in mind, just having a low federal funds rate doesn't necessarily mean that you'll get access to money easily. I'll talk about that because now we live in a post-pandemic world where the federal funds rate is low. It's actually 0.05% at the time I'm recording this video training. But banks are not willing to lend money because banks are not sure if consumers will be able to pay because consumers don't have jobs. So this creates essentially what I hope, what I believe is a once in a lifetime situation, a once in a lifetime problem that we hopefully never ever have to face again, because there's never ever been a situation like this in our economy. So let's go back to transactions. Fundamentally, there are transactions between you, the consumer, and businesses. Then there are transactions between businesses and banks that they borrow from, whether it's a loan, a line of credit. And then those banks essentially borrow money or have their monetary policy regulated from the Federal Reserve, the central bank, or the Fed, like I mentioned earlier. So fundamentally, our whole economy is a whole bunch of transactions between consumers, between small businesses, banks, and the government. So the way the US economy works is there's a buyer and a seller. With every transaction, there's a buyer on one end and there's a seller at the other end. The biggest buyer and seller in the entire country is the US government. Like I mentioned earlier, the US government consists of a central government and a central bank. Now, the job again of the central government is to be able to collect taxes, to write laws, to spend money. And the job of the central bank is to regulate the amount of cash in the system and regulate the amount of credit available in the system with the rates, the credit rates, the interest rates. So the way it does that is it sets policy for interest rates and it sets policies for printing money. So when you think of the word transaction, I want you to think of something as simple as going to a convenience store and buying a pack of gum. It could be something like going to a grocery store and buying groceries. That is a transaction. It could be, for wealthy individuals, a transaction is buying a $600 bottle of wine at dinner. In fact, you're watching this video right now on YouTube. This is a transaction because when you see an ad appearing in the video, that's actually a transaction between you and YouTube because YouTube is getting paid to show you an ad. It's phenomenal. Our whole world essentially runs by way of transactions. Now, what does all this have to do with the current state of the economy and where we live in today? Let me tell you one thing. At this moment in our economy, in the history of our nation, there are 3 individuals that will essentially decide and make major decisions that will get us out of this. Number 1 is the president. Number 2 is the Federal Reserve Chairman. And number 3 is the Secretary of the Treasury. Because the Secretary of the Treasury is responsible for formulating and recommending domestic and international financial, economic, and tax policy. It's a very crucial thing right now because it affects our day-to-day life. The Secretary of Treasury also participates in the formulation of broad fiscal policies that have general significance for the economy and managing the public debt. So again, there are three individuals right now that really matter more than any other time in the history of our nation: the President, the Federal Reserve Chairman, and the Secretary of the Treasury. So what does all of this have to do with the economic machine as it exists in this world, as it exists in the post-pandemic world? Now, I talked about a buyer and a seller in a transaction. I talked about the buyer needing cash and credit. In a normal world, when interest rates are low, banks are more likely to give money, more likely to provide low interest loans. But in this environment, we have an unusual situation where we have low interest rates, and on top of that, banks are unwilling to lend money. Banks are wanting to hold on to their money. I talked about this in other videos. Banks like Wells Fargo and JP Morgan Chase Bank have actually stopped issuing home equity line of credits. Think about that. The bank is not willing to lend you money based on an asset that you own. So imagine if banks start tightening up on credit, if banks start lowering credit card limits, not giving home equity lines of credit, not providing loans to small businesses, not providing lines of credit to small businesses. That's actually going to crush our ability to spend money, because again, as a buyer, you need some amount of credit in order to be able to buy stuff. Now, for those of you out there who think that, credit is a bad thing, when used responsibly, credit is not a bad thing. I know there are a lot of financial experts who say credit is bad, but credit, when used responsibly, is not a bad thing. So when we have credit and when we can buy things, that creates a transaction, and that then drives the economy. So in this post-pandemic world, what the government is trying to do is to unlock the flow of money, not only by creating low interest rates, but by telling banks, hey banks, go ahead and lend money to consumers so that consumers can spend money. So again, we're in a situation where I believe that you watching this right now, yes, you are actually the center of the solution. Now, I know at times, and I read a lot of comments on my channel, I know at times we sometimes feel that we are pawns in a game and we feel that the system is rigged. I'm not going to lie to you. I think the system is rigged in favor of the big banks, in favor of big companies, in favor of these big corporate entities. That is true. So what you suspect is true. However, I'm here to tell you that at the end of the day, it is the US consumer that drives the economy, because a majority of the US GDP, of the US gross domestic product, comes from the spending of low wage earners and middle class Americans, more so than individuals who spend a whole bunch of money. An individual going to a McDonald's to buy stuff off the dollar menu, yeah, they spend maybe $3, $4, $5, and then maybe a rich person at a restaurant spends $600 on a bottle of wine, let's just say. Guess what? There are a lot more of the low and middle income earners than there are of these individuals who are in the top 1%. So for every person that buys a $600 bottle of wine, there are hundreds, thousands, tens of thousands, millions of people who buy that pack of gum, who buy that burger, who buy groceries by clipping coupons. Because we as American consumers, we drive the economy. We essentially are the engine that drives the entire economy in the US and by extension the rest of the world. So I want you to take comfort in the fact that at the end of the day, the system understands that it needs to serve us so that we can get back on track. And that, by the way, also is one of the reasons why all this talk about more stimulus is going on. There needs to be more stimulus because there needs to be more money in the hands of Americans so that we can spend. We are spenders. We are not savers. The average savings rate in the United States has been anywhere between 6 to 8%. I saw a recent survey that said it shot up to 13% in the past couple of months. But that's not because we're saving more. That's because we're spending less, which means we now have a little bit more cash in the bank. But fundamentally, we as Americans are hardwired to be spenders. A majority of us are spenders. We are not savers. And it is when we spend money that the economy grows, that more transactions are created. So again, the economy comes back to the number of transactions and the size of the transactions. The more the number of transactions, the greater the size of the transactions, the more the economy grows. Because remember, when you buy, someone else is selling. There is someone at the other side of the transaction. When you order groceries online, when you go to the grocery store, or you go to the post office, all of it is a transaction. Like I mentioned, you watching this video, when you see an ad pop up, that's a transaction, like I mentioned. And speaking of that, all I ask for is that you click the like button. If you are a member of our community, I hope you're enjoying this video training so far. If you're not a member of our community, please, all I ask for is that you click the subscribe button, you click the notification button so you get an instant update, and also please click the like button because it helps the YouTube algorithm. So I'm not asking for anything else. That's all I'm asking for. I wouldn't even call it a transaction. I'd call it a personal favor to me as something that you can do to value and appreciate the creator who's putting out this content for you. So with that being said, let's get to what this ultimately means for you and what I see happening in the future with potentially negative interest rates. But before I get into that, let's take a look at this chart on your screen right here. As you can see, across all income groups, individuals across America have been badly hit by this pandemic. In fact, individuals who make less than $50,000 a year have been almost as badly hit as individuals who make more than $100,000 a year. If you look at the very significantly portion of this graph, by the way, this is from the Financial Times, phenomenal reporting by the Financial Times. Individuals making less than $50,000, 29% were very significantly impacted. They were very significantly impacted because they believe that this pandemic has reduced their family income, and 26% were somewhat impacted. When we look at the $50,000 to $100,000 income category, the numbers were 20% very significantly and 31% somewhat. And here's what's interesting. In the more than $100,000 mark, you might think, oh, they're doing well. But guess what? 35% said they were somewhat impacted, and 19% said they were very significantly impacted. Amazing if you look at that. This again just gives you a sense of how this entire situation has affected a broad range of the US economy, which, by the way, is why the interest rates, I believe, are not only low right now. As of the recording of this video, the federal funds rate is 0.05%. In other words, it's almost free to borrow money. In fact, the way I look at it, banks are getting paid to borrow money because they borrow at 0.05 and then they just lend to us at 3%, 4%, and they make that spread. By the way, that's how banks make money. I'll cover that in a little bit more detail in another training video, because I think for us to be able to grow in this system, we need to be able to understand the system, which is what this channel is about. So again, if you are learning something, please click subscribe, please click like. I would really appreciate it. Let's take a look at the next item on the screen. Now here you'll see that Americans, this by the way also is from the Financial Times, you'll see that Americans have changed their behavior drastically over the past month as a result of this pandemic. A lot of us are avoiding public places, yours truly. A lot of us have cancelled or changed travel plans. I was scheduled to be in business meetings in 5 countries this year. I had all my tickets booked, I had all my hotels taken care of, all of it was done. I cancelled everything. My wife and I and my children were going to go on a luxury cruise. We cancelled all of that. It's all cancelled. Putting off large purchases, most Americans have cancelled it. Changing investments has been another change in behavior. And it's been, and only a small percentage of individuals, which by the way was up in the 90% back in February, and now it's down to less than 30%, which is 29%. So there's been a big drop in individuals who said there's been no change. In short, there's been a substantial shift in behavior. Now let's take a look at the next chart. Americans' concerns over a worldwide financial slowdown have grown dramatically. What do you think is going to be the biggest threat to the US economy? If you take a look at this chart, look at that surge in that blue bar that sort of just shot up. A potential slowdown in the global economy is the number one concern for most Americans. And if you see the other things all the way at the bottom, disputes with major trading partners like China, which by the way, trade deals with China and Mexico were a big part of the national conversation a few months ago. Now, guess what? Almost nobody cares. The loss of high-paying jobs due to automation, which by the way was something that came up during a lot of the discourse in the last few months, no longer a problem. So right now you can see that most Americans are concerned about a slowdown in the economy, not having enough money to pay their bills, and fundamentally changing their behavior and putting off large purchases, of cancelling travel plans, and essentially cutting as much discretionary spending as possible. I talked about the economy throughout this video. I can tell you one thing, there's one factor that controls the economy to the exclusion of all else, and that factor is human emotion. If we are emotionally uncomfortable with spending money, which by the way happens when we're stuck at home, you're not going to travel, you're not going to do all of the things I talked about. If you're emotionally not going to be willing to do that, it doesn't matter what low interest rates, it doesn't matter how low interest rates are. It doesn't matter that businesses reopen. It doesn't matter if airlines start flying. It doesn't matter if hotels want you to come back. I can tell you, speaking from my own personal in my own personal opinion, is even if restaurants open, even if even if airlines open, even if I have business meetings in other parts of the world, I'm not going. I'm doing everything by video conference until I feel comfortable. And me personally, I'll feel comfortable when there's a vaccine. That's it. That's how I feel. So you can see that overall the state of the economy in a normal world and the state of the economy in this new post-pandemic world is completely different, and our goal right now is obviously to recover from this and to get back on track. As far as negative interest rates go, other countries in the world have done it, but there are significant pros and cons to negative interest rates. I don't believe we here in the United States need to have negative interest rates, but ultimately the decision is going to be made by the Fed. By the way, our president is a fan of negative interest rates, so I will talk about the pros and cons of negative interest rates in a lot more detail in another training video. But right now, with interest rates being low, what you can expect as a consumer is you can expect low mortgage rates, you can expect low rates for car loans. That's if you feel comfortable about getting those, and at some point someday we will. Thank you so much for watching, everyone. If you're here, please consider subscribing, please click the notification button, and please click the like button. I would really appreciate it. That really helps out the YouTube algorithm. I will talk to you about this in a little bit more detail in the next training video, and I appreciate you for watching. Thanks so much.